Welcome to StockTok's deep dive into Roblox Corp. Roblox operates one of the world's largest user-generated content platforms, a metaverse-style ecosystem where users create games, experiences, and virtual worlds that other players explore and monetize. The company generates revenue through a virtual currency system called Robux, taking a percentage of transactions. It is a communication services company operating in the interactive media space, and it fundamentally shapes how millions of users, particularly younger demographics, engage with digital entertainment. The stock is trading in the lower half of its 52-week range. As of May 13th, the stock is trading at approximately $42, well below the 52-week high of $150, but only slightly above the 52-week low of approximately $41. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Roblox operates a two-sided marketplace. Creators build experiences, and players spend real money on Robux to enhance their gameplay, customize avatars, and purchase in-game items. The company takes roughly a 25 to 30% cut of Robux spending, creating a powerful network effect. The more creators build, the more players engage, and the more monetization opportunity exists. The competitive moat rests on this network effect, user-generated content scale, and switching costs. Millions of players have invested time, money, and social relationships into the platform, making it hard to leave. The company's StockTok score is 53 out of 100, rated a hold. Breaking down the 5 dimensions, valuation scores a 10 out of 20 stretched relative to profitability. Financial health scores 9 out of 20, concerning. Profitability scores 6 out of 20. The company is burning cash at the operating level. Growth is the bright spot, scoring 20 out of 20. Revenue has expanded significantly. Smart money activity scores 8 out of 20, mixed conviction from top institutional holders. Now, valuation. The question every investor has to answer: are you paying the right price? Roblox is not currently profitable on a trailing 12-month basis, which means traditional earnings multiples like the price-to-earnings ratio are not meaningful here. The forward price-to-earnings projection is also 0.0 times, reflecting analyst expectations that the company will not reach profitability in the next reported period. Similarly, the price-to-earnings growth ratio, which compares valuation to expected growth rates, is 0.0. What we can look at is the enterprise value to EBITDA multiple, that is, the total value of the company relative to earnings before interest, taxes, depreciation, and amortization. Roblox trades at negative 36.2 times EBITDA, a metric that becomes distorted when EBITDA is negative, as it is here. The price-to-sales ratio, which divides market value by total revenue, sits at 5.79 times, meaning the market values the company at nearly $6 of market cap for every $1 of annual revenue. For context, high-growth software and internet companies often trade in the 3 to 8 times price-to-sales range, but that typically assumes profitability or a clear path to profitability. Roblox's margin of safety, the cushion between the current price and intrinsic value, is sitting at 0%, meaning the market is pricing the stock at a premium to our discounted cash flow analysis. Looking at Wall Street analyst targets, 32 analysts cover the stock, with a consensus mean price target of $66. The high target sits at $105, the low target at $46. This consensus implies approximately 57% upside from current levels, a significant gap between institutional expectations and where the stock actually trades. Taking both signals together, a reasonable fair value range in our view sits between $50 and $70, representing approximately 19 to 67% upside from current trading levels. The latest quarterly results, reported approximately 53 weeks ago, showed the company missed on both earnings and revenue. Earnings per share came in at negative 0.41, worse than the negative 0.36 estimate. Revenue hit $1.44 billion against an estimate of $5.3 billion, a miss that warrants attention. The silver lining: revenue growth on a year-over-year basis still expanded at 1.9%, though deceleration is evident. The company's market sentiment leans bullish, with investors taking some comfort in the long-term platform potential, despite near-term operational headwinds around child safety measures and tighter monetization policies. The valuation here is interesting, but not cheap on a sales basis, and it hinges entirely on whether management can restore profitability while maintaining growth. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist that evaluates balance sheet and income statement health, comes in at 5 out of 9 for Roblox. That is a failing grade by institutional standards. A score of 8 or 9 typically signals financial strength. Roblox is below the midline, indicating deteriorating profitability, negative operating cash flow trends, and balance sheet stress. The Altman Z score, a bankruptcy risk model, scores 1.42, well below the 1.81 threshold that marks financial distress. In plain terms, this score suggests material default risk and warrants serious caution. On the debt front, Roblox maintains a cash-to-debt ratio of 1.79, meaning it holds approximately $1.79 of cash for every $1 of debt. That sounds reasonable in isolation, but context matters. The company's interest coverage ratio, a measure of how many times operating earnings cover interest expenses, is 0.0 because the company is not generating positive operating income. It is burning cash to service debt, a deeply unsustainable position. The current ratio, which measures short-term liquidity by dividing current assets by current liabilities, is 0.89. Any ratio below 1 signals that the company cannot cover its near-term obligations with its liquid assets alone. The debt-to-equity ratio, a measure of financial leverage, stands at 4.14, meaning the company carries $4 of debt for every $1 of shareholder equity. That is highly leveraged and constrains financial flexibility. In summary, the balance sheet is under stress. The company is not generating positive operating earnings, cannot cover its debt service from operations, and is burning through cash. This is not a financial fortress, and it is not a financial fortress that has the runway to absorb significant additional operational challenges. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is negative 14.73%. This metric reveals how much profit the company generates for every dollar of capital deployed. Negative return on invested capital means the company is destroying shareholder value at an accelerating rate. The gross margin, profit after direct costs of producing the service but before operating expenses, is a healthy 78.45%. This indicates Roblox has strong pricing power and low marginal costs for delivering its platform experience. That is the good news and where the profitability story starts. The bad news: the operating margin, which includes all operating expenses like engineering, product development, and trust and safety costs, is negative 24.01%. For every dollar of revenue, Roblox loses 24 cents in operations. The net margin, which is the bottom line profit after all expenses, is negative 20.69%. The free cash flow margin, operating cash flow minus capital expenditures, stands at a positive 28.73%. Free cash flow margin is often a more reliable metric than accounting earnings, and this figure suggests the company is burning less cash from operations than the negative net income would imply. However, free cash flow can be misleading if the company is depleting working capital or deferring expenses. In Roblox's case, the gap between negative net income and positive free cash flow deserves scrutiny. The latest quarterly results referenced earlier showed operating income of negative $290 million and net income of negative $250 million on revenue of $1.44 billion. The company is operating at a massive loss. The path to profitability requires either significant revenue acceleration, substantial cost reduction, or both. Until that path materializes, profitability remains a critical weakness. On to growth. Is this business expanding, and at what rate? This is where Roblox's thesis gets interesting. Revenue growth over the trailing 3 years averaged 30% annually. Over the trailing 5 years, revenue growth averaged 27.2% annually. That is exceptional growth for any software or internet company and far exceeds the broader market average, even with the modest 1.9% year-over-year growth shown in the most recent quarter. The long-term trajectory is unmistakably upward. The company has more than tripled its revenue base in the past 5 years, which is why institutional investors maintain conviction despite the profitability challenges. Book value growth, the increase in per-share equity value, over 3 years has been only 3.3%, a sign that equity has been heavily diluted or earnings retention has been negative. The company does not pay a dividend, so the dividend yield is 0%. The growth profile, then, tells a familiar story in venture-backed consumer tech platforms: explosive user and revenue expansion, severe monetization friction, and a race against the clock to achieve profitability before capital runs out. Roblox has grown spectacularly, but the growth has not translated to shareholder value on a per-share basis, and the company still operates at a loss. Now let's talk smart money. What institutional capital is actually doing with this name? 11 top-tier guru investors currently hold Roblox, which signals some conviction at the highest levels of asset management. However, the direction of that conviction is mixed. Looking at 13F filings, the mandatory quarterly disclosures by large institutional investors, only 5.2% of 13F filers are net buyers in the most recent quarter. That is a weak showing. Consensus in the institutional community would be above 50% net buyers. The insider ownership picture is concerning. Management and company insiders own only 0.84% of outstanding shares. When founders and executives own very little, the incentive alignment with shareholders is tenuous. Over the past 3 months, insiders have executed 0 buy transactions and 16 sell transactions. This is the clearest signal. Insiders are reducing their exposure to the stock. Looking at the top guru holders, Value Act Capital, which managed billions in assets, holds 6.89% of its portfolio in Roblox and added to that position over the period covered, increasing their stake by 39.52%. That is meaningful commitment. Henry Ellenbogen at Durable Capital Partners holds 0.89% of his portfolio in Roblox, but reduced his position dramatically by 67.06%, a clear vote of no confidence. Lee Ainsley at Maverick Capital holds 0.45% of his portfolio in Roblox and added to it by 25.82%, signaling renewed interest. The smart money picture, then, is fractured. Some top managers are increasing exposure, others are cutting, and most of Wall Street is neutral to slightly bearish on new purchases. The insider selling, combined with the low insider ownership, is the most important signal here. It suggests those closest to the business are taking cash off the table. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at nearly 6 times sales, which is elevated for a loss-making business, though Wall Street's consensus of $66 suggests 57% upside, implying the market is mispricing the stock. On financial strength, the balance sheet is under material stress with negative interest coverage, a current ratio below 1, and a Piotroski score in the distress zone. On profitability, the company is burning substantial cash at the operating and net income level, though free cash flow remains positive, creating a reconciliation that warrants scrutiny. On growth, the revenue trajectory is exceptional at 27 to 30% annually, a multi-year run that few companies in the sector have matched. On smart money, conviction is divided, top institutional holders are split, and insiders are selling aggressively. In our view, a fair value range for Roblox sits between $50 and $70, representing 19 to 67% upside from current levels. The latest quarterly results and ongoing insider selling reinforce that near-term execution risk remains the primary challenge to this thesis. The setup is one of a high-growth platform burning cash, while building what could become a dominant entertainment property. If the company achieves profitability while maintaining growth, the upside is significant. If it does not, the balance sheet deterioration and insider exodus will prove to be warning signs. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Roblox Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.